A new week is here, and this time it's week 17. I've just been to the dentist with my voice sounds a little bit off. That is the reason, it's not AI generated. Still some anesthetics left on the left side, making my mouth a little numb. But anesthetics or no, we cannot wait. A new trading week is here. You're listening to the Trading Tips with Jim, and for the better part of half an hour, we will look at the market, the week ahead of us, and dive into a few other issues that may or may not affect your trading. As I told you over the last few weeks, I'm slowly changing the format of the podcast. And these changes involve actually being a little bit more personal. For a long time, I've been dreaming of doing something I did many years ago when I first started trading back in '96. Back then, I had equal to like $450 on my bank account. And I thought I would try trading. Ever since, I got hooked on trading. And that first journey was a real strong upturn, making a lot of money, especially using technical analysis. I dream of repeating that success one more time, and think I would like to share that with you. Meaning that for the last few years I had the trading portfolio, but I want to start on the scratch again. We find a certain amount which most of you can follow, and we'll see if we can repeat the success story from '96. Back then, as I said, I was mainly using technical analysis, loving trading on the relative strength index, trends, and a few other very easy candidates. It was especially doing something called dead cat bounces, because when you have a small amount, you need some bigger gains. Got very successful doing that strategy, was growing very hard for years and years. And I think the markets are somewhat similar to that, because we are in a bear market and have been for a while. Some signs are showing that we might just be at the end of it. But try reading some of the news and you will get very confused, because it is about 50-50 between the bears and the bulls as we speak. Some argue that there is a huge upturn coming, while some says there is room for a brutal fall ahead. I've tried to navigate you through this, but I feel somewhat the same. We are in a situation where things can easily start to rally upwards and equally easy start to fall. Last week I told you there was a huge double top formation in the chart, indicating a fall down to, if I remember correct, around 10,500 on Nasdaq. And overall these podcasts, I've been doing this now for more than 3 years, told you how inflation would come, how it would rage the market, all these things. I argued for that I think Nasdaq will go as low as 8,000 and that the bear market will end with a brutal fall. As we speak, Nasdaq is at 12,072 points, was up down 0.42% last week. So staying about 12,000 for Nasdaq. Dow Jones fell with 0.23% to 33,809. So 8,000 is quite a huge fall from today's level. At the same time, I argue that I think by the very end of May, I think I even gave the date of 26th. And you may wonder, so how do you come up with the date of 26th of May? Well, that is just based on previous history and turns. There is a very common expression, sell in May and go away, because May usually is often brutal. Now, will that be the case this May? Will this May be the hammock? Will I be correct that there have to be some major falls before we finally hit the bull market? Hard to say, but it's not likely that Nasdaq will fall from 12,000 to 8,000 during just 1 month, because it's just a month left, more or less. For that to happen, there has to be some brutal news. And what are the news that is plaguing the market? I told you long before the Ukraine war started that the Ukraine war would come. And I also told you that I think during first half of 2023 that the Taiwan conflict would come. We are getting to the end of the first half of the year. It's only a few months left, and then we are in second half of 2023. There is nothing as we speak showing that there will be an instant conflict with China, but everything is brewing up for the conflicts. There has been several talks between world leaders. Some, I don't know, argue that Biden will not be able to keep his promise to stand by Taiwan if China goes harder on, meaning using military forces, either entering Taiwan or otherwise forcing Taiwan towards that direction. US will not be able to intervene. Many reasons for this. One is, of course, the Ukraine conflict going. Having two battles at one is never a good idea. Oil reserves being at a record low and weapon production slower than normal. And if you've been following this podcast, you know that I, for instance, went into Northrop weapon factory, weapon producer, simply because there is so much money in war as we speak. Knowing that Ukraine conflict is just making Ukraine a gravel pit day by day, like it was supposed to do. If you are very interested in this, you can go back and listen to strong professors talking about these things even back in 2014, how Ukraine will be used and how Ukraine just will be a gravel pit in the end. Sad for absolutely everyone it concerns. It's even sad for the world that these things are happening, but now they have to play out. As is, it's somewhat steady. There is nothing indicating that there will be a major blowout in Ukraine, but you never know. But for Nasdaq to fall from 12,000 to 8,000, we need something very heavy. So with Ukraine conflict somewhat stable, and no real sign of rapid escalation for the Taiwan conflict, there is really nothing. It has to come out of the blue, because in general, now is quarter season. There will be tons of companies delivering results this week. We already know that in general the quarter results are coming in 6.2% lower than previous quarter, but all of this is expected. The market is expecting this, has been expecting it very long. It's already in the price. So there has to be something totally exceptional on that front if the market suddenly can reach really fast down. On Thursday, there will be GDP numbers. These, of course, can trigger the market. If the markets get into a very negative sentiment, you can have that fall as people will try to secure their profit. So the scenario that we will have Nasdaq as far down as I think where the final Nasdaq bottom will be doesn't seem very likely. And you may wonder, so, well, what about all this talk possible 8,000? Then I say it's not as likely. We might be turning. It is indeed a very good exercise trying to foresee all possible options, because that helps you a little when you are finding the stocks you invest into, how you position your risk. And nothing is better than if the markets just go straight to 16,000. But you may tell me, because I really don't know, why there is a huge upside as we speak. Quarter results coming in slowly. If you look at inflation, you see a lot of different messages. Some say the inflation is under control. Some say that the Fed has to increase the interest rates more. And you just get very confused. But look at the underlying basic things driving inflation, energy being one of them. Energy is still high, and it is expected to remain high despite oil falling a little last week. And with energy high, you can expect inflation to remain high. And on top of this, we have and we see more and more people being fired, especially in the tech industry. People is being laid off. All of these things brew for a worse economy situation. We do know that the stock market will turn long before the market do. But if we are heading into a brutal recession, nothing can help the stock market, even though my guess for a turn in May will not happen. We can have fall for the next 2 years. These things have happened before. It is just a matter of figuring out where. So with a lot of uncertainty in the markets, where is that huge upside? Well, it has to be greed driven. Everyone wants in, or some sudden peace talk, because if we get some peace talk for Ukraine, these things can really fire up the stock market in general. When the risk for escalation will be less, we can deal with many of the other consequences, because that, as I've been telling you for so long time, the war is dividing, everyone is dividing East and West. We have the BRICS countries getting stronger, we have the pressure on the dollar, and there is so much ongoing behind the scene which you do not see. And not to be conspiratoric, but the news do not always reflect the truth. And that's another good thing if you are a stock trader, investor, whatever you are, day trading or investing longer. Try to read as many news sources as you can to get a little diverse view. Because if you read news, for instance, today or more or less all last week, you see that the company CEOs say that they foresee hard times, but the general of them say that it will be okay. But it's their job to say that it will be okay. No sensible person don't talk his company. That would hurt the stock tremendously. Only Elon Musk, as far as I know, is the guy that can pull it off, don't talking his own company without hurting it too much. He has done that on several occasions. But if the boss of CEO General Motors or any huge company come and say that no, we think the future will be extremely hard, we're going to lose tons of money forward, the stocks will be hammered. They have to deliver some forecast, but they will always try to paint it as good as they can. So when you read articles about CEOs being quite optimistic, think there is a bull market ahead, I would personally deduct quite much for it. On the other hand, we have hedge funds, and they say that now it will be the worst market you ever seen. That the Dow Jones will fall 50%, the Nasdaq may even fall 70%. So they talk from a total different interest. You have to try to find that level just in between. And that's been the focus in all these podcasts, trying to convey the long lines. And the long lines, they are still not for a very strong upside, I would say. It's getting slowly better, only because the market's been falling as they have. Nasdaq from 16,000 down to 12,000. And that, of course, makes it more attractive. But in general, the overall market is still negative. Anyway, we will always see in the end how it will play out. Who was correct and who was wrong. Personally, I hope that I'm somewhat within the trend. I have a strong feeling that I've been so right over all these years that I might get things a bit wrong now in the end, before the market turns exactly where it will turn. But as I told you, I think, and I really believe that, it will be a strong year. And that brings me back to the thing I said about changing the concept a little bit of this portfolio, this trading podcast, to restart a portfolio, because it was the same back when I started in 96. Market was heading for a huge upturn. I was able to cap in on it, and I think we are in somewhat similar situation. If I'm wrong and the market falls longer than I think, still we are much better off than Nasdaq was 16,000. Anyway, we will get to that. The other thing is that over the last, I would say more than a year, I try to focus more on YouTube than the audio version, which is on Spotify, etc. It was to combine both things to see if I could get some traction on YouTube. Last week, because this podcast has been delivered on the Stock Investor YouTube channel, we moved it to a separate YouTube channel. So if you didn't find the video on YouTube last week, it's been moved to Jim Trading Tips, Jim Stromberg channel, and I might paste, or I will paste a link in the description if you want to watch it on YouTube, so you can find it. Now, you may ask, so why do you flip? Well, this is just technically because the video is not returning any results on YouTube, and a very kind user suggested that on this the channel you have way too many videos. If you want for organic growth, put it on a different channel, because YouTube would appreciate that much more when it's a total new channel. So that's the reason for the growth, and maybe you can learn that in your investing world as well. Trying something new is often the way to change bad habits. And if you've been on a very, very losing streak in your stock trading, maybe take a break, read a little, reorganize, reshape your thoughts, and start all over again. Anyway, I said that there will be some changing to the podcast, and in general I would like to go a little bit more back to the audio format, not focusing so much on making it a brilliant YouTube video, but instead making it a nice, more personal approach. I have shared personal things with you before, and I will continue to share some personal stuff. It's more the things that I do on side. Things that make me very happy, helps me even when trading, because I told you need a solid base. Good friends, if you can have good relation with your family, because if you have that solid base, when you hit that downturn in the stock market, and you will, most of you probably already have lost quite much money. You see your savings getting reduced heavily just in a single trading day, even just a few minutes. Good trades suddenly turning bad. If you have a solid base, you can return much faster, much stronger, because stock trading is highly emotional. Even after all this year, I can feel every time I trade a little bit how emotional it is, and how fast you go from being extremely optimistic to being totally pessimistic. It's a long process to learn how to be more relaxed about it. And that will be maybe the biggest lesson for today. If you can, never trade with money you need. Only the money that you can lose, because there is really no guarantees in this game. And if it's money you can lose, you will be more relaxed. And when you're more relaxed, you actually do better decisions, believe me. Because when you are playing with money you cannot lose, meaning you are either using gearing. Let's say that you have a broker who offers to lend money, so you put in $1,000 and then you borrow $4,000, and you're playing with $4,000. So you're playing with $5,000, and then you hit a 20% downturn, you have lost more or less all the money you put in. So, as I advised many times before, in a downturn market, very uncertain market like now, you should not play with such gearing. Avoid it by all costs. Play with money you can lose. That will enable you to sleep much better. And when you sleep much better, you will do a lot of better decisions. And so I am more than happy to share small things that I do that keep me very happy. And in this time of the year when the sun and the good weather is coming, I love metal detecting. I was metal detecting when I had the chance last week. No great finds. As you remember a few weeks back, I found a very, very nice silver coin, and I think this year, along with the stock market, will hold many great finds. And if I find something, I will tell you and I will show you. On top of this, I do a lot of business development, trying to develop the business, the main business, the Stock Invest Web Hexagon is the name of the company, and the Stock Invest page, and a lot of things are coming up which I really think that you would like. I am and have always been very, very curious, trying to find the super algorithms that can convert my knowledge into a scriptural design, meaning that scripts can evaluate stocks the way that I evaluate them and looking at them. And it's been ongoing actually since 96, more or less. I've always been looking into how can I do this. And that involves many, many things. And maybe I will share some of the thoughts, but it might be that some of you love technical analysis and striving to be better. I always told you volume is one of the absolutely best tools to use, but try to remember that when speaking about volume, make it liquidity, meaning that you multiply the price and the volume, because huge volume in a penny stock doesn't equal much money in general. If the stock is 001 and you have a 1 million volume, it's really absolutely nothing, while 1 million in Microsoft is insane amount of money. So you have to convert things into proper readable format, and the first thing to learn is, and whenever I refer to volume, in 90% of the cases I actually mean liquidity as such. So trading liquidity is the best factor. Now, relative strength index is maybe the easiest of the technical indicators that you can learn. Relative strength index, just measuring how many days the stock is going up for a certain period, gives you a number between 0 and 100, and when it's below 30 it's oversold, when it's above 70 it's overbought. This is the traditional classic definition of relative strength index. But if you are like me and you want to make it even better, then you should personalize the relative strength index, meaning that you do not use the general principle on all stocks. You personify it, and you do it by checking the levels, the previous historic levels that, for instance, Microsoft have gone to. Does it really turn around 70? Does it turn at 80? Maybe even at 90 relative strength index? And if it turns usually around 90 on the relative strength index, does 70 really represent oversold territory? I have done tons of tests about this, and there is no doubt in my mind that you have to personalize the analysis to the stock. Relative strength index is just one of them, but you will experience that your relative strength index training, if you use it for your trading, will become much, much better if you're able to find the level where the stock turns either on the upside or the downside, going from a fall to a rising trend. And even back, as I told you, back in 96, when I had my $450 starting trading, and I was using something called a dead cat bounce, is when the stock falls extremely hard. Get into oversold territory and you just trade the bounce, which is coming in most cases, and we can argue later about how much, etc., and how you can try to identify the levels and possible percentages. Even back then, I used personalized relative strength index, because turning at 30, if the market or the stock is very negative, seldom really applies. It can go down to 17, maybe even as low as 11. So do the exercise. If you love technical analysis, try to start personalize the stock, the technical indicators to the stock. Using moving average 100 is a general thing, and 200 is a general thing, but you will get way better off if you start personalize it. So that was just a tip for the more advanced of you. Working all this, I play a lot around, and another thing that I really love is correlation. How do stocks correlate between each other? Because that really, even how does a stock correlate towards gold, how does it correlate towards oil, etc., because that gives you an idea, and you can trade based on if you have a stock. Let's again take Microsoft. Microsoft correlates with a certain amount of stocks. Now, if all the stocks that Microsoft correlates with, meaning that they move in the same direction, the correlation is like this. It's between -1 and 1. 0 means that there is zero correlation. The stocks move just totally independent of each other. If it's -1, it's negative correlated, meaning that if a stock goes up, the other stock go down. If they correlate together, being let's say 0.8, 0.9, or in some cases 1, very rare but very high correlation, they move in the same direction. Now, Microsoft, let's say Microsoft again correlates with some 20 companies. What do you think happen if the better part of these 20 companies go in an opposite direction like Microsoft do? That statistically tell you that there is a huge chance that Microsoft will drop, getting back to the correlation level where they correlate. Now, I love also programming, always have since I first started learning it, and I made correlation, actually the thing that I'm speaking about now, I made that available. You can go to Get a Graph. Get a Graph was actually the first web page I ever started. I later took it down. I built a monster of a page. Got too technical, too heavy, and I got into technical depth, meaning that my error logs was building up too fast, and the page got too popular, and eventually it just choked itself. The server couldn't handle the traffic because everything was in bad programming. That concept I later moved over to Lithuania and Vilnius to rebuild it using skilled people, skilled technicians, and rebuild back my original concept. And we are moving faster and faster, getting it back to the level where I once had my webpage. The old webpage was called getagraph.com, and when I started here in Lithuania, we made it stockinvest.us, which many of you probably are using and are visiting quite regularly. So just maybe a year ago, I just brought back Getagraph to life. I had to wipe out everything, so it's not even close to what it was before, but I brought back getagraph.com to life. So if you go to getagraph.com and you type in the ticker, you will see the correlation and which stocks it correlates with, and if everything is working. And have me excused if not everything is working, because it's just a hobby project which I run. It's just for my fun, playing around with things and sharing as I go. You will find correlations, statistics, and the chart should work. There is a chart with a 1-minute delay where you even can see the correlation levels, how the stock correlate. Now, that's just for you. If you're curious, have a look, and maybe you can use it. So how can we use correlation? We can use it, as I was saying, finding stocks that deviate from the correlation, because if they deviate, they usually will get back on track. They will fall back to the correlation, either if it's sector-wise or stock-wise, or even towards an index commodity, whatever it is. it will get back. Well, I remember I also correlated the stocks towards the different currencies, so you can see how it moves in terms of currency. And it's usually, let's say, a huge company, American company, have very, very big overseas sales made either in euro or pounds or whatever. There might be a slight correlation. So if the pound is moving up or the euro is moving down, you can see it reflects in the price line of the chart. The other way to use correlation is if you build a portfolio. You do not want stocks that correlate too much. Why do you want stocks that all do the same? You want to hit different scenarios. You want to hit the fast running scenarios. You want to hit the resistant stock that can tolerate inflation. You want to hit stocks that can be in trends, different things. Short runners, long runners. So why do you want similar stocks? That is when you want to try to avoid, correlation. So then you can find stocks that do not correlate. And on the same page, getagraph.com, you will find also the stocks that do have a negative correlation to the stocks. But in general, and there is a tool where you can type in the tickers of the stocks that you want to correlate to see if there's any correlation between them. This is a portfolio diversification, this is portfolio building, and we will get there over time. I spent a quite long time just to get you through the basic levels, and now I'm starting to share a little bit more of the advanced things. Anyway, we are 31 minutes into the podcast already. I will have to produce it, get it up before the market opens, so let's push a little forward. The week ahead of us, Thursday will be GDP numbers, so make sure to keep an eye on Thursday, because if something very unexpectedly happens, that's absolutely a number that can shake the market. And during the week, there will be many huge earnings results. All of them have the potential to move the market a bit. Start already today with Coca-Cola. Tomorrow will be Google, General Motors, General Electrics, McDonald's, Microsoft, PepsiCo, Spotify, and it just keeps going. Even Visa will be tomorrow. Wednesday will be another strong day where Meta, for instance, will come with their quarter numbers. And Meta have been moving quite much up and down lately. Speaking in a longer term, having that huge fall, we were trading quite actively in Meta. If you remember, we did some super trades in Meta when it fell down to 96, trading from these levels. And lately not been trading so much in Meta, as I think that we now are somewhere where things again can get a little heavy for Meta. All of the bigger tech companies, they are laying off people at very fast pace. And for yourself, think what that will do to growth. In general, what happens when the high-paying people get laid off? Will market growth continue? The economic numbers continue to be strong, or will there be layoff in also other businesses as the high payers will have less money? Will they shop less? And how will it affect? You can do these thought process yourself. Thursday and Friday, tons of big numbers coming up. Snap is one of them. Friday, especially for oil, when Chevron, which we have in the portfolio, will have their numbers together with ExxonMobil, for instance, and all. So exciting week, and all of this tells me that there will be a very volatile week ahead. Oil, as I said, had a slight fall last week, fell 5%, a little more than 5%, to $78, currently trading around $78. Was taken more or less down by the expectations for a slower economy in general. Gold fell by 1.35% last week, trading just under $2,000 at $1,997. 10-year Treasury yield was up by 1% last week to 3.57. In many ways, this week will give much telltale if we are to bounce up I expect very volatile week, so play your bets according to this, and make sure if you have any of the stocks I mentioned, or you have a slight idea that there will be quarter results for your stock, check it, because most stocks have huge reactions to the quarter results. In general, I started the podcast saying that in general there is an expectation based on the previous quarter so far that more or less all of the companies will, in average, again we talk average, show 6.2% decline in the results. All of them say the same thing more or less, that the prices are higher, they cannot take all the price hikes on the customers, so the margins get squeezed. We have talked about this over and over again in the podcast, leaving less room for top profit, but there is other things that you really have to pay attention to, not always the profit levels, running costs, how the ability to improve the running cost, and sadly in many cases that means people being laid off to improve the running cost, or the ability to push the cost on the end consumer. But when the buying power of the end consumer get less, it will be harder to do. So what kind of niche is it in? Is it in the niche with the things that you absolutely have to do? Because the first things we start to cut, and maybe you have done the same thing already, starting to cut off on subscription that you really don't need, and other things, skipping maybe a coffee latte now and then, because it's the typical process when cash get less. We will end this week's podcast looking at the stocks from the previous portfolio. It's nothing big, because indeed it was a slow week. Most of the three stocks that were in the portfolio fell by 1% or so. Sumerica didn't do anything special, ending the week at 21 cents. I think it was down 1% or something. Nothing special from Sumerica. I hope that the quarter results coming from Sumerica will maybe push the stock, but in general, absolutely nothing. Northrop also fell by like 1% or something, from 472, some 50 or whatever it was last week, to 471.99. We are still in profit, but barely. In Northrop, 0.66% since I bought it in week 8. But it's doing exactly what I hope. It is holding the gain. I sleep much better knowing that if there is a bloody red day for the IT stocks tomorrow, Northrop is not in that sector. It's in the sector that they're raking money now, because they go triple, quadruple shifts trying to produce enough war material, as warmongers still are pushing the agenda of war. EU arming up, every single country is arming up, and now Sudan is going to war, so there is tons of money to be made for the weapon industry still, meaning that they will rake in money and they will for sure pay high dividends. Chevron, which is a oil share, fell by the same 1% or whatever it was, following the market more or less, ending the week at 169.12. Still up 4.3% since we bought it in week 9. So these hold the ground. As I told you, I'm not exactly sure where the market is. I want to be in the game in case it moves up, but if it falls hard, I want to have stocks that can stay afloat. Having Sumerica is a gamble. Last week I told you I think it's possible to do a NEO trade. I tried. Of course I had to try. I bought NEO on Monday. I got in at 9.63. I think it was low, 9.40ish. I got in at 9.63. Everything was looking damn good as it was heading up. I think it headed just above 10 something. And then the Wednesday came and the game was more or less over. But I used trailing stop loss, meaning that I was following the stock upwards. And when 10.03 or the top was found, 20 or whatever, you have to check exactly what the top was. The stop loss just moving up, it started to count down to the breaking level and was cut when it fell below 940, currently sitting around 860, 70, I don't know. That's the total purpose of stop losses. So I was wrong about NIO. I was not able to make money. I had to take a 2.39% loss. I sleep very well with a loss of 2.39. I wish, of course, it was different. What about the week ahead was? Well, I will be in Sumerica, I will be in Northrop, I will be in Chevron. I think all of these stocks still are a good buy in the current situation. I'm not adding any more stocks. I might pick up, I have more portfolios than this one, but this is the one that I mentioned in the podcast. If any stocks get hammered on quarter results, moving totally too fast, maybe you have watched Tesla being hammered last week over quarter results. As we speak, Tesla is showing all the signs for a possible $10 gap. It will be a risky trade. Technically, everything looks like it really will do it. I think that you should have a quick look yourself. Look at the charts. What do you think? And that may be the stock tip for this week. I might even do, or maybe I even have already done the trade. Anyway, it's not for this portfolio because it's still a risky trade. Now remember that got bounced, that oversold the relative strength index, all these things I've been speaking more than 5-10 minutes during the podcast about. This is exactly the same thing. Now if some quarter results come out, stocks being hammered, let's say it's Google, there will be a buying opportunity because the markets and the traders always overreact, sending it way too down. They don't fully see the consequences, etc. That was the super trade that we did in Meta. As I told you, it was totally irrational, falling from 230 or whatever it was down to 96. That is so irrational that you can pick money like from a tree. We did that to Tesla, we did that to Meta, just picking easy money. I expect now, as there is quarter result, there will be more of them, and if I see them, I will jump in. But be patient, and here comes the final lesson of the day. I spent a little bit of time trying to tell you about relative strength index, how do you personalize it. Now, example, I do not say that will happen to Google. Anyway, you know that AI thing, Google being hit pretty hard in the market by ChatGPT and all the concurrents coming with AI taking over the search volume, etc. Well, let's say Google have a bad quarter result and bad guiding, because that's another thing that they guide forward. If it happens and Google fall quite hard, I'm not sure if 30 will be the oversold level. It may be very much lower than that. It may even go to 10 before that really good buying opportunity will become. So try personalize it. See if you can find. How do you do it? Well, you have to do the exercise of looking at historical relative strength index numbers, figure out where the common bottom is, and that will give you an idea of things. I already have made these things. We will get back to it later. So plenty of options for you this week. I will have hopefully a good week in the market. I hope so. But more than other things, it's a nice week because trees are blooming here in Vilnius. It's so nice to be outside. Heat is starting to come. It's a very good time of the year, and I hope I will have the time to go sneak off for a little metal detecting and maybe continue the hunt for the perfect algorithm. Now, some of you maybe have went to live.stockinvest.us checking out the live services that we are building. Here will the algorithms come when they are finished. Now we are running some dummy algorithms so you can just see and feel the experience as we develop it. So if you haven't checked it out, check it out, live.stockinvest.us. And if you're interested in these correlation things that I mentioned, along actually with some live signals as well, you can check out my developer page, getagraph.com. Getagraph.com, like in getagraph.com. I can only hope you will have a super week. I hope you enjoyed this somewhat longer podcast than expected. 45 minutes, we will end it here. That you have a good day and that your mood is somewhat good. Just please take your time, read more about all things related to stock trading. Have these strong connections, as I said, with things that make you happy, so you have a solid base. A volatile week is waiting ahead of you. And when we speak in 1 week, I hope you have made good greens in your portfolio. Till next time, have a super week. Bye.
Welcome to StockInvest.us Stock Analysis. We remind you that trading involves a high risk of losing money, and that you should speak with a financial advisor before buying or selling any securities. You should not base your investment decision upon StockInvest.us. By using the information you agree and are held liable for your own investment decisions.